Hi, everybody. Thanks for coming to Invest LYH. I'm just going to do a quick video here. Well, it's not so quick because I got a couple topics to discuss, but I did want to mention that if you guys are not following me on Twitter, please do so. It's Invest LYH. And I'm doing a Twitter Spaces right now where I'm just kind of setting up this video here, but I'm going to do it on Twitter Spaces as well to see if I can kind of generate some more followers and see what you guys think. And one of the things that I was mentioning on the Twitter space is a lot of people, you guys kind of see my cash on cash return videos. And if you see me on Twitter, then you see some of the information that I put on Twitter and the questions that I ask. But a lot of you don't go to the YouTube channel to see what my background is. So my background is in economics. I am trained in multiple model building. I have multiple degrees in economics, and I basically take what I have learned over the years in terms of economics and apply it to the real estate world. And I also do look at the consumer, uh, kind of like behavioral economics, where you look at what is the consumer going to do in terms of different decisions that they make when they choose. Because basically, economics is the science of choice, right? There are scarce resources on the one side. How do we take those scarce resources, manipulate them so that the most people are served on the other side? That is basic economics. And when you look at, I'm an individual, you're an individual, we make choices individually, but when you take those as a collective, it's an aggregate um, curve that we can review and see, okay, this is what most people are doing. So that's kind of how I come about real estate investing. That's kind of how I come about reviewing the market, things like that. And one of the things that I've been looking at lately, a lot of people are saying, "Oh, we're in for a correction. We are going to see prices drop." And my question is, right, about consumer behavior and it's about choices that we make. Well, who is going to make the choice to leave their sub 4, sub 3% interest rate, and why? And a lot of people, they just say, "Oh, it's like 2008 all over again." Well, we kind of learned a little bit of lessons in 2008, and the way that the financing is structured now is much different than it was in 2005, 2006, which led to 2008. And I just don't see people making the choice of, I'm going to leave the home that is less than rent down the road because I got laid off, right? And the other thing too that really gets me in this is there is a number called full employment, which generally throughout my entire adult life has been 6%. We are below that. So it would take several percentage points to get up to full employment, right? For the unemployment rate and the employment rate to match full employment. The other thing about that is a lot of people are, "Oh, well, we're going to go up to 10% unemployment." And what the question that I ask then is I say, okay, so in this scenario, you're telling me that out of every 10 people, 9 of them are working. And in that scenario, you are telling me that prices are going to plummet based off of that. I just, I can't see that happening. I just don't see that happening. So um, I guess this is more, maybe I'll do two videos today. I'll do one on the topic I was going to do and one just introductory, which kind of came about because I'm using Twitter to do the Twitter Spaces, and just kind of a refresh of who I am, what my background is. I will tell you presently I work, but I also I go to school, and I'm doing a graduate program with a focus on real estate. It's probably going to end up being about a 5-year program. But it's kind of, you just take the classes as you can. And well, for me, because I'm working, but well, it's a doctoral degree in business administration. So it's a step above an MBA. I've been doing that for about a year now, and you just continue to progress, and then you have a project at the end. Um, So I have access to a lot of scholarly research in order to review as well whenever I take a look at the market and I'm like, okay, well, what happened previous? What are the changes that occurred then that are not occurring now? And that's another big issue that I have with the people who are preaching doom when it comes to the real estate market is when they say, oh, well, 2008, 2008. Well, we're in a different market now. If you look at transactions, they are down as opposed to what they were in 05, 06, right? So you can't compare apples to oranges, is what my old econ professors used to tell me. And a lot of people think that 08 was the main issue with '08 was they think that it was real estate that caused the crisis when it was really financing in a specific industry, which happened to be real estate that caused the crisis. And then what happened is that bled over into the lending market, which then bled over into the employment market, which then bled over into the real estate market, which caused the prices to drop. That's not always the case in recessions. Sometimes individual markets have recessions, whereas other ones are perfectly fine. So you have to be able to kind of take a market and be able to divide it up into multiple segments and be able to look at that segmentation and say, what are the supply demand functions of these segments? Are they fundamentally sound? Are they not? Right? That's what you have to do. And those are the types of questions that I ask a lot on Twitter because a lot of people, they just want to have that blanket statement where they don't understand that the market is dynamic, it is not static. We can look back at it empirically and be able to identify certain areas based on a static assumption built model. Real life doesn't happen with assumptions. My neighbor is pretty old. When she passes away, the children might sell the house. That's an assumption that I'm making, but I mean, they might not. They might move in. So if I'm banking on being able to buy my neighbor's house when she passes away because of the assumption that I have, well, real life isn't based on it. It's not. You can't base your life on assumption driven models. You have to be able to take the assumption driven models and apply them to real life. So once after a month or so to when my neighbor passes away, I'm going to be able to know whether or not that house will go on the market because I know the assumption driven model and what the consumer behavior is in that, and I'm applying it to real life. That's what a lot of people fail to do on Twitter. And a lot of people are busy, so I don't fault them for it. I try not to be a jerk, but I do ask questions, and sometimes I'm pretty pointed. It just depends on the type of day that I'm having. So, but anyway, this is the first video that I'm going to do today. Just kind of reintroducing myself, giving you a little bit about my background, and talking about how I use economic theory to review the real estate market. So thanks so much, guys, for watching. Continue to watch my videos. I'll try to do some more cash on cash returns. I am in the middle of rehabbing a property right now that I just purchased. And I'm going to do some more photos and some videos on that as well. Thanks so much, guys.